Welcome to the Ryanair Q1 results conference call. As always, I'm joined this morning by our Group CFO, Neil Sorahan, and we're pleased to bring you the Q1 numbers this morning. As you'll see, we posted early this morning on the Ryanair.com website the Q1 results, reporting a Q1 profit after tax of €820 million, more than double the prior year Q1 PAT of €360 million. Traffic grew 4% to 58 million passengers, but fares, as we have previously guided, have jumped significantly on last year's weak prior year comps. Remember, the two halves of Easter were in April this year, only one half was in April last year, and this time last year we had that boycott with the OTAs, which we have since resolved. So the Q1 highlights: traffic grew 4% to 58 million passengers, revenue per passenger rose 15%, average fares were up 21%, a big jump but against a weak prior year comp. Unit cost inflation has been just 1%, which means the cost gap between us and our airline competitors across Europe has materially widened, as their unit costs have jumped significantly more than that. We have very competitive fuel hedges in place that de-risk the group from the recent fuel price volatility. Currently, as we stand today, we've 86% of FY 2026 hedged at $76 a barrel. We have 181 Boeing 737 game changers in our fleet of 620 aircraft, and that includes 5 deliveries we took in Q1. This summer we'll operate over 160 new routes out of a total of 2,600 routes. In recent weeks, we announced a deal to buy 30 spare CFM LEAP 1B engines at a significant discount, and we bought those to improve our resilience, not just this summer, but for the next couple of years. And we're very pleased to report that Ryanair was added to the MSCI World Index. I think, and you'll see from the results, these numbers speak for themselves, so I don't propose to dwell too much on them. I would caution, however, that Q1 here was artificially boosted by the two halves of Easter being in April and a weak prior year comp. Q2 will not be as strong. Nevertheless, for outlook, FY26 traffic remains on track to grow by just 3% to 206 million passengers, and that is, our growth is being constrained by heavily delayed Boeing deliveries. We expect modest unit cost inflation in FY26 as our delivery of more Boeing 737 game changers, advantageous fuel hedging and effective cost control across the group airlines help to offset dramatically increased ATC charges and higher, even though entirely unjustified, environmental costs. While S25 travel demand is strong, Q2 fare increases will be lower than what we've just reported this morning in Q1, which benefited, as I've said, from the full Easter holiday in April and weak prior year comps. We now expect to recover almost all of last year's 7% fare decline that we suffered in Q2. We expect to get back almost all of that in the current Q2. The final H1 outcome, however, is very heavily dependent on the strength of close-in bookings for the remainder of August and September, and is normal at this time of the year. We've zero H2 visibility, where the prior year fare comps normalise and last year's modest delivery delay compensation will roll off. It remains therefore too early to provide meaningful full-year profit after tax guidance. We cautiously expect to recover almost all of last year's 7% full-year fare decline, which means we now expect the average fares this year will return to where they were in FY 2024. This should lead to a reasonable net profits growth for FY26. However, the final FY26 outcome will remain heavily exposed to any adverse external developments, and that includes obviously the risks of tariff wars, macroeconomic shocks, conflict escalation in the Middle East, Ukraine, and European ATC strikes and mismanagement, which continue to bedevil our summer operations. And with that, Neil, I'll hand over to you to take us through the slide presentation.
Thank you, Michael, and good morning, everybody. Ryanair, as we know, has the lowest fares and the lowest costs of any airline in Europe, and indeed our cost advantage continues to widen over competitors. We're number one for traffic and will carry 206 million passengers this year. We're number one for on-time performance and reliability with high customer satisfaction scores. Sustainalytics and other rating agencies continue to rate Ryanair very highly on ESG, and our 300 MAX 10 order will underpin a decade of growth, and this, coupled with our financial strength and lowest cost, makes Ryanair the long-term winner. This summer, we're operating a peak fleet of 618 aircraft, which, as I previously said, should help deliver 206 million passengers in the coming year. We've 330 aircraft on order, including the remaining 29 in the Boeing Gamechanger order book. And this should facilitate growth, profitable growth to 300 million passengers by FY34. Our cost advantage continues to widen over all comers. You can see at the end of the quarter, €35 per passenger ex-fuel, which is now nearly 80% lower than the next nearest competitor. And we expect these cost gaps to just widen further and Ryanair's competitiveness to increase over the coming years. On the quarter itself, as expected, we saw 58 million passengers, a 4% increase on last year at 94% load factors. Average fare recovered, enjoying the benefit of a full Easter in April week, prior comps, and modestly higher close-in bookings, so it rose by 21% to €51. We saw a solid performance from ancillary revenue, which was up 7% to 1.39 billion, or up 3% on a per passenger basis. And as a result, total revenue increased by 20% to 4.34 billion. Costs put in a strong performance, rising 5% or 1% on a per passenger basis to 3.42 billion, as we saw a strong fuel hedging offset significant increases in ATC, which was up 16%, and rising environmental costs. So putting all of that together, we saw a profit in the quarter more than double to €820 million. Balance sheet, Fortress balance sheet remains rock solid. It's BBB plus rated by both Fitch and S&P. Uniquely, Ryanair owns our Boeing 737s. They're on the balance sheet unencumbered, and liquidity remains very strong. 4.4 billion in gross cash at the end of the quarter and over 2 billion in net cash, which places us in a strong position to repay our maturing bonds over the next 10 months. And with that, Michael, you might take us through current developments, please.
Yeah, thanks, Neil. So we're seeing robust summer 25 demand. Fares look like they will recover last year's decline. Q1 was, as we have emphasised, artificially strong. Fares are up 21%. We now expect Q2 fares to recover almost all of last year's 7% decline. So we have strong forward bookings, strong pricing, close-in bookings remain reasonably robust, but they are subject to adverse news flow, particularly the close-in bookings as we move through the remainder of August and September. Disappointingly, we'll have slower FY26 traffic growth. It's only to 206 million passengers due to those Boeing delivery delays. We're pretty confident at this stage, though, that we'll get the remaining 29, the delayed 29 A200 aircraft will be delivered this winter, well in advance of summer 2026, and therefore we'll catch up that growth to 215 million passengers in FY27. That constrained capacity means we have to be much more rigorous in where we allocate that growth, and we're allocating those growths to regions like Sweden, regional Italy, Hungary, where we see regions cutting taxes. I announced a big growth in Warsaw Modlin last week, again on the back of airports stimulating traffic growth. We're very well hedged, the fuel, and these fuel hedges don't get us lower cost, but they do de-risk the group from volatility. So we're 84% hedged for FY26 at $76 a barrel, and we're already 36% hedged for FY27 at $66 per barrel, a 13% saving into next year, already locked away. We did buy the 30 spare LEAP 1B engines. We negotiated a meaningful discount on those engines, and I think that's a sensible use of our balance sheet. When our partners are looking to raise money, we should be able to jump in there and buy CapEx in a way that improves resilience but also lowers our costs. We're very pleased to have been included in the MSCI World Index in June, and we expect the FTSE Russell will include Ryanair when they review their index in September. The strong liquidity, as Neil has said, we have net cash of 2 billion. We need those funds, though, to be able to repay. We have very large debt repayments coming in the next 12 months, an 850 million bond repayment in September, and then the last 1.2 billion bond in May of 2026. And we believe that this sets us up, particularly with Boeing get the MAX 10 certified by the end of this year, for a decade of low fare, profitable growth to 300 million passengers by FY34. Just to touch briefly on Boeing. So as I said, we've 618 aircraft in the fleet, including 181 game changers, 5 of them delivered in Q1. The quality and the timeliness of Boeing deliveries has dramatically improved over the last 12 months. Boeing have hit their rate 38, production rate 38 on the 737 in May, and did so again in June. And I think that's a testament to the good job Kelly Ortenberg, Stephanie Pope and her team are doing, particularly on the ground in Seattle. We're therefore taking the final 29 game changers well ahead of summer 26. In fact, the first 5 of those aircraft are due to deliver in August of this year. Boeing asked us to take them early. It doesn't suit us because we can't deploy them, but we're happy to take them early so we guarantee we don't have any delivery delays running into summer of 2026. Boeing have advised they expect the MAX 10 certification to take place, 7 and 10 certification to take place in late 2025, might slip into Q1 of 26, but well ahead of our first deliveries, which are due, first 15 MAX 10s are due in the spring of 2027. And I'm pleased to say that Boeing have now confirmed in writing their confidence that they will deliver those first 15 MAX 10s to us in the spring of 2027 in time for the summer 27 peak travel. And these aircraft will transform Ryanair's economics and further widen the operating and the cost gap between us and every other airline in Europe. These aircraft offer us 20% more seats, 228 seats. They burn 20% less fuel. They're also 50% quieter. So they will dramatically transform our cost base and make us significantly more efficient going forward. And as you see, we set out a schedule there. The only change there has been on FY26. We had originally planned to grow to 215 million. That growth has been staggered over the 2 years, FY26 and FY27, and then by which stage we believe we will have eliminated all of the Boeing delay issues that we've been struggling with over recent years. And we know already from our discussions with airports all over Europe, they can't wait for us to take these aircraft. We could deploy all 300 of these aircraft today based on the growth deals we have at airports, existing and new airports across Europe. But so we're very much looking forward to those aircraft and to taking those deliveries.
So as Michael already said, we expect to deliver modest 3% growth this year to 206 million passengers. Having enjoyed a strong Q1, Q2 demand is robust, and fares, we believe, should recover now most of the prior year Q2 decline. I have to caution, however, that the H1 outcome remains very dependent on close-in August and September bookings, over which we don't have huge visibility at the moment. We would, however, cautiously expect at this stage that we'll recover almost all of the prior year 7% fare decline that we saw last year. This depends on us obviously not having any tariff wars or economic downturns in the second half of the year. On costs, we're sticking with our previous guidance of modest unit cost inflation, as we see our strong fuel hedges help offset rising ATC route charges and environmental costs. As we look into the second half of the year, as is always the case at this time of year, we've no visibility into H2. Again, I would flag that comps get tougher in the second half of the year, where we saw the normalisation of OTAs and fares in Q3 and Q4 last year. And indeed, we will start to see the modest Boeing delay compensation unwind as we take delivery of those final 29 game changers this year. So I think it's probably too early to give meaningful profit after tax guidance at this stage. We do, however, see fare recovery. We do have strong cost control in the business, and on the back of that, we would expect reasonable profit growth, but too soon to put numbers on that. This all is very much dependent, as is always the case, on no external shocks. So long as we don't see economic downturns, tariff wars, geopolitical risks, and ATC mismanagement, then I think we're on track to perform well this year. And indeed, with the 300 aircraft order book, the strong balance sheet, in a strong position to grow profitably to 300 million passengers per annum by FY34.
Michael, Neil, good morning. Starting with your results, Ryanair's Q1 PAT more than doubled to 820 million. What were the key drivers?
Yeah, well, we saw traffic increase by 4% to just under 58 million passengers. This was driven with fare recovery, 21% increase in fares, although we did benefit very much from having a full Easter in April of this year. As you'll recall, there were weak prior year comps, and then there was modestly stronger than we would have anticipated close-in bookings, particularly in May and June. On the other revenue line, ancillaries, we saw another solid performance from our ancillary revenue, increased by 7% to 1.39 billion, or on a per passenger basis, a 3% increase to just over €24. Cost put in a strong performance, rising just 1% on a per passenger basis, as we saw the benefits of our strong fuel hedging offset a 16% increase in ATC route charges and rising environmental costs. So we're seeing the likes of the SAF blend mandates coming in this year, free ETS allowances starting to roll off. But, overall, a good performance in the quarter.
Ryanair enjoys competitive fuel hedging. What's your current position?
Yeah, so we're for the remainder FY26, we're 85% hedged at $76 a barrel. That's a 4% saving on our hedge price in the prior year. And already for FY27, we're 36% hedged at $66 a barrel, a 13% saving on our FY26 hedge rate. So we're in a strong position both to make significant fuel cost savings, but also to eliminate the kind of volatility we saw and have suffered in recent months.
You mentioned environmental costs are increasing. How much are they this year?
Yeah, it's a big number. It was 850 million euro last year included in our fuel cost, just over €4 per passenger. This year, with the SAF blend mandates coming in, with the ETS free allowances rolling off, that's going to increase to over €5, €5.30 per passenger, or about 1.1 billion. Significant number, as I said. And I think it's remarkable that none of this gets recycled back into environmental projects across Europe. We don't see any of it going back into the production of SAF. We don't see it going into latest technology aircraft. So I think if Europe are really serious about competitiveness, it's timely that they take a hard look at this and abolish these penal taxes, because they're not delivering from an environmental perspective.
Turning to the balance sheet, Ryanair's industry-leading balance sheet is BBB+ rated. What are the key call-outs?
Well, I think the obvious one is the 600 Boeing 737 fleet, which is entirely unencumbered. We have strong liquidity. We're currently at the quarter end sitting on about 4.4 billion of gross cash, just over 2 billion of net cash. But we need those funds, as we have two very large bond repayments coming at us in the next 10 months. An 850 million bond in September and a 1.2 billion bond next May. But that puts us in a strong position to pay down our debts and hopefully by the middle of next year be entirely debt-free, with a large fleet of aircraft completely unencumbered. And I think that maximises or increases the financial flexibility, which also materially widens the cost gap between us and our competitors in Europe, most of whom are heavily indebted either through bond and or aircraft leasing, and they're exposed to expensive financing and aircraft leasing costs at a time when we own our aircraft, and the only cost we suffer on those is depreciation.
What is FY26 CapEx guidance?
I think we'll be close to about 2.2 billion. Now that reflects the 30 spare CFM LEAP engines that we announced back in July. It doesn't include any CapEx that may or may not be needed in relation to the engine shops that we're looking at developing towards the back end of the decade. So there may or may not be some CapEx in relation to tooling and spare parts this year. And of course, it's heavily dependent on Boeing delivering the aircraft when they say they will, although we'd have a high level of confidence that we'll get them all ahead of the summer next year.
Moving on to shareholder returns, can you please update on the current share buyback?
Yeah, as you know, we launched a 750 million buyback program in May. We're very early into that program, but during Q1 we bought and cancelled about 2.8 million shares at a cost of about 60 million euros. We're happy with the broker's progress on the latest buyback, particularly given the MSCI indexation and lower market volumes.
When is the next ordinary dividend?
Well, we've declared a final dividend of 22.7 euro cents, and as always the case, this is subject to AGM approval in September. So as soon as it's approved, it'll be paid fairly quickly after that.
Shifting to fleet and growth, what's the latest update on the MAX 8 game changer deliveries?
Yeah, so we took 5 additional game changers in quarter one. Currently, we have 181 game changers in the fleet. We're 29 aircraft short. We will take all of those deliveries this winter, well in advance of summer of 2026. And I think the fact that Boeing have in recent months been hitting their rate 38 will enable them to go to the FAA and get clearance to increase to rate 42. Leaves us much more confident that we will complete this winter the entire 210 game changer order, and puts us in good shape then, we think, for the MAX 10 deliveries as well in the spring of 27.
Is there any update on the MAX 10 certification?
Well, Boeing are still indicating that they expect the 7 and the 10 to be certified towards the back end of 2025, with a slight risk that it might slip into early 2026. But we've received confirmation from them recently that they're working very much on the basis that they'll be delivering our first 15 MAX 10s as per contract in spring 2027.
What's the latest on aviation tariffs?
Like most industries, there's still no real clarity. The US, however, has postponed the tariff implementation from the 9th of July to the 1st of August. We believe from publicly available sources that there's progress being made on the EU-US tariff negotiations. However, there is cautious optimism that commercial aircraft and aircraft leasing will be exempted from tariffs, primarily because the US is such a big exporter of aircraft, engines and spare parts. However, in our agreements with Boeing, the purchase price is agreed. It's a fixed purchase price, and therefore tariffs will not be a problem for us. But we will work with Boeing to minimise any tariff impact on our aircraft deliveries. But we would hope that commercial aircraft will be exempt from the next round of tariffs, as they have been for many years since the 1979 tariff exemption agreement.
What are your views on European short-haul capacity?
I'd expect European capacity to be constrained for at least the next 5 years to 2030. We see the two big OEMs, Boeing and Airbus, still behind on their production targets. Order books are full out to probably the middle of the 2030s. Then we've got the Pratt & Whitney engine issue continues to rumble on. And M&A is kicking off again in Europe. Recently we had Air France saying they're going to bring their stake in SAS up to 60%. The new government in Portugal are now going to put TAP up for sale in the coming weeks. Air Europa is getting more mention. So I see capacity hugely constrained for some time to come.
Where are you allocating your constrained 3% growth this year?
To those countries and regions in Europe who are abolishing environmental taxes, Sweden, Hungary, regional Italy, where we've announced new bases this year, and also to those airports who, like-minded with Ryanair, are stimulating growth. And again, I point to the fact that we announced a doubling of our Warsaw. We plan to treble our Warsaw model and traffic over the next 5 years, rising from 1.5 to 5 million passengers on the back of a long-term multi-year growth agreement. And we expect that trend will continue. There will continue to be new base growth in Sicily, Poland, Modlin, in Hungary and in Sweden. And we're also expect to be announcing more new bases and new routes this winter as we take delivery of 29 aircraft for summer 2026.
Moving on to ownership and control and ESG. Ryanair joined MSCI World Index in June. Is there any update on FTSE Russell?
Well, firstly, I think I have to say we very much welcome Ryanair's full inclusion in the MSCI World Index. This has been a positive development for our shareholders. Looking at the criteria for FTSE Russell, we would expect to be included in their index when they do their next calibration in September, although they have flagged that any inclusion will be on a phased basis, probably over a 2-year period. But still, if it happens, another positive development.
What are Ryanair's Q1 ESG highlights?
Well, I suppose it's taking delivery of 5 new game-changer aircraft, 4% more seats, burn 16% less fuel, and 20% less CO2 emissions. We also continue to benefit from the winglet retrofit on the NG fleet. These winglets deliver 1.5% fuel efficiency and a 6% reduction in noise. And I think the fact that we bought 30 new spare fuel-efficient CFM LEAP 1B engines at a reasonable discount shows our continuing commitment to buying new technology that will lower our carbon consumption, lower our emissions, and we expect that trend will continue. Although, as Neil has said, we and the other airlines, other European airlines, are now campaigning vocally for a reform of Europe's failed environmental tax regime. It is indefensible that European citizens and European airlines are the only ones paying environmental taxes. And the way to deliver that level playing field is to move ETS tax rates into line with CORSIA, which is what the long-haul non-European airlines pay. And we'll continue to demand that move to CORSIA rates ASAP. If Ursula von der Leyen again is serious about delivering competitiveness in Europe, as the Draghi report has pointed to, we need a level playing field in the case of environmental taxes for air travel in Europe.
Can you give more detail on the LEAP engine deal?
Yeah, it's a big deal. It's a $500 million investment at list price, although as Michael said, that there is a reasonable discount in there. So that'll see our pool of spare engines increase to 120, which is a massive investment by Ryanair in our operational resilience. Importantly, these LEAP engines will be able to be used on not only our game changer aircraft, but on the MAX 10s when they come into the fleet. And they'll deliver over the next 2 years. In fact, we've already taken some of them this year, this summer, which helps underpin our 2025 summer operational resilience as well.
And lastly, on outlook, what's the group's FY26 outlook?
Well, as we've said, we expect traffic growth will be constrained by only 3% this year to 206 million passengers. Q2 demand, that is the September quarter, is robust. We now expect fares will recover most of the prior year 7% Q2 fare decline. However, the final outturn for H1 is heavily dependent on the strength of close-in bookings for the remainder of August and September. Nevertheless, we now cautiously expect to recover almost all of last year's 7% fare decline in the full year. As previously guided, we see modest unit cost inflation up 1 or 2% this year, as our very strong fuel hedges are offsetting runaway ATC cost increases and rising environmental taxes. It's still too early to provide a meaningful guide for full year profit after tax guidance, as we've zero H2 visibility and much tougher prior year comps in the second half of the year. But I think it's reasonable to expect FY26 profit growth, reasonable profit growth with fare recovery and strong cost control. The final outcome will, however, continue to be subject to shocks, tariff wars, conflicts, and recurring and unacceptable ATC strikes. We had 2 ATC strikes on the French ATC strikes on the 3rd and 4th of June. We were forced to cancel 500 flights over those 2 days, cancelling the flights of nearly 100,000 passengers. About 90% of those flights would have continued to operate if Ursula von der Leyen and the European Commission had simply protected overflights over France. And it is simply unacceptable that the Commission continues to sit on its hand, allowing the single market to be shut down by a tiny number of French air traffic controllers. But we live in hope of seeing some reform and some move towards competitiveness within the EU Commission. Thank you for that. Neil, thank you very much. Jamie, thank you for the questions. And we look forward to talking to you on the conference call, which will be held later on this morning at 10 o'clock. Thank you.